Morning, everybody. Welcome to Money Court's Market Pulse webinar for April. It's great to have you all with us. Well, over the past several weeks, geopolitical tensions in the Middle East have re-emerged, and that's been a major, if not only, catalyst for global market volatility. What we've seen is that military exchanges between the US and Israel on one side and Iran on the other has created problems in energy markets. It's affected things like interest rate expectations and also foreign exchange markets. And so we'll be moving through what the implications of this conflict are, what some of the other larger macroeconomic trends might be, and looking at the potential winners and losers, or losers and worse losers, from this conflict. All of this is unfolding at a time when monetary policy was delicately poised, and we saw all of the central banks in March not do anything with monetary policy, apart from the likes of the Mexican central bank and the Brazilian central bank, who both cut interest rates unexpectedly. But future decisions are potentially for higher interest rates as the effects of inflation are more widely felt. So over the next half an hour or so, we're going to bring some additional insight to help guide you through your financial planning and your FX planning over the coming weeks, months and quarters. And hopefully we'll be able to fill you in on what the opportunities and dynamics are at play. Thank you for those that have pre-submitted questions. There's still the opportunity for you to submit questions. That's using the Q&A box. So if you have any burning issues on the financial markets that you would like to address, then do feel free to utilize that. And let's hopefully dive into the situation now and provide you with that greater clarity that you seek. So if we look first and foremost at the key areas that I'm going to cover, things like global growth and whether the stimulus that's already been in situ will take hold or whether it will be superseded by the possibility of rate increases to come, the inflation problem and what the likely outturns will be for most of the major economies, interest rates and where they're heading, labour markets and the problems that we're seeing there, geopolitics and the problems that are likely to not last for a few months or quarters, but potentially years. And then finally, we'll look at not only the FX outlook, but also some key questions that you might want to be asking at the moment. So if we look at global growth, I said that this is waiting for the stimulus to take hold. Well, the reality is that as far as the situation is concerned, growth is expected to be weaker. And I would expect that global growth will be materially weaker than we were previously expecting. The OECD in their March update, it's an interim forecast, has suggested that 2026 is going to be weaker than previously anticipated for most economies. One of the things I would say is that it appears that the UK and the euro area are the ones that are performing the worst. Not only that, but we actually saw some modest improvement in expectations for growth in other economies. And I'm surprised as well that heavy importers of energy from the likes of Japan and China are not seen to be as at much risk as the problems that we're seeing for Europe and the UK. In terms of the other things that I think are still at play here, you are seeing safe haven flows, so you might see more money flowing into the likes of Switzerland as well as the US. Now, whilst that's potentially good news in terms of their currency performance, it might be bad news in terms of their economic activity performance. So whilst there will be a dual effect here, I think underlying economic activity is likely to be weak across the globe. Particularly weak in places like the Middle East. They're seeing a lot of their global energy infrastructure being damaged by the effects of the war, and therefore their major export industry suffering materially. The Strait of Hormuz is closed at the moment, and that means that global energy supplies are much more stressed. Now, the fortunate thing here is that we're moving into a period of lower energy usage as far as households and businesses. But in terms of transportation and freight, it is still going to be problematic and potentially inflationary on a wider scale than just the energy impact. If we look at inflation, biggest influence, as I mentioned, is energy. And I've got on the right-hand side of this particular slide, the oil price. Now, we have seen oil prices coming off over the course of the last sort of 12 hours or so. That's after comments from the US President Donald Trump, where he seemed to indicate that the US may withdraw from the region, or at least from the conflict, over the coming weeks. And that's irrespective of whether negotiations go well or not, or whether all military objectives are achieved. Meanwhile, the problems for the major economies is that most of them were still operating with inflation above target levels. So if there is an increase, and we've already seen that with the likes of the euro area, that will push inflation levels to a region that is incompatible with interest rates remaining at the levels that they are. And that's one of the reasons why central banks are suggesting that they may raise rates. There are also a number of areas in things like welfare payments, and also as far as wage inflation is concerned, that we haven't seen what the effects of this is likely to be in terms of those. And if there was an uplift in those areas as well, then expect that the central banks would react negatively to that, even though the bulk of this inflation shock is international and therefore won't be influenced materially by a couple of rate increases. Notably, as far as interest rates are concerned, the likes of the Bank of England and the European Central Bank are not expected to react quickly, even though expectations have moved materially, whereas the US has seen a lesser impact on its interest rate expectations. And yet, I think that is demonstrating that there's a geographic threat to this war in the Middle East that's probably not best factored into the performance of financial markets. You have seen UK and European equities underperforming slightly, but nowhere near to the extent that both of those economies could be more negatively affected in economic terms than the likes of the US. Equally, if you look at oil prices, going back to the previous slide, oil prices in the US have been less materially affected by the war in the Middle East. Then Brent crude has been less affected than we're seeing for Middle Eastern oil suppliers. So Middle Eastern energy costs have risen very substantially, whereas UK and Norwegian Brent prices have increased, but by not as much. And then West Texas Intermediate, which is the US oil price, has been much less affected. And the same thing can be said of things like gas prices as well. So there's definitely a more significant regional impact dependent on which region that you're talking about. If we look at labour markets, well, labour markets are still very problematic for central banks, because whilst on the one side you've got these inflation problems that are potentially going to lift interest rates, for most of the labour markets at the moment, we're seeing a worsening in conditions. So we've seen that in the UK and in the US. The euro area had been seeing some improvement, but recent data would suggest that that improvement is coming to an end. And equally as well, there had been a downward trend in average earnings growth generally, but we're not necessarily going to persist with that if there's a more general inflation threat that's likely to cause households some pain and pressure with regard to monthly budgets. So labour markets, I think they need more help, but they need more help in a situation where I think central banks have their hands tied behind their back. It will be interesting to see whether there is a delayed reaction to labour markets in terms of the effects of, or the risks of, higher interest rates, whether you see employers cutting back because their costs are increasing, or whether there are other areas that businesses start to cut back on, for example, very expensive AI investments. So we have no information on this at the moment. This is a fluid situation, but I do think that businesses will have to reconsider investment plans and hiring plans over the remainder of 2026 because of the war in the Middle East. And if we look at that war, then I think there are some significant questions to ask. I've already asked a few of those, but I think the biggest one is whether or not a deal will be reached. And if you look at the headlines that keep getting released over a 24-hour news cycle On the one side, you have a much more optimistic view from the US that something will happen, that the Iranians want to make a deal, but the Iranian government and parliament would suggest otherwise, that they're not even in discussions and not prepared to make a deal unless there are some significant guarantees and concessions from the US. Meanwhile, we saw yesterday the US President Donald Trump talking about Europe needing to step up and protect the oil supplies coming through the Strait of Hormuz, and also potentially having to provide more protection for the Suez Canal, given that the Houthi rebels in Yemen have started to saber rattle there. So I think there's some significant problems for European supplies, not only of oil and gas or energy more generally, but things like fertilizer. And I've mentioned this on previous webinars, where fertilizer provisions from the Middle East amount to around 40% of global supply. So there's a clear potential problem there. But what about the squeeze on consumer spending? Because where are most of these problems likely to manifest themselves? Probably not in discretionary items, but probably much more so in necessity goods. So the cost of producing food, the cost of filling up your car, the cost of heating and lighting your home or business. Those are where we would expect to see the bulk of the inflationary problems feeding through. So higher energy costs, higher transit costs and transportation costs, and higher food prices are likely to put a further squeeze on discretionary spend in 2026. And that tends to be where we get the bulk of growth from. And then if we move away from the conflict in the Gulf and we start to consider some of the broader implications, what about FX? Even if the US was to walk away or there was to be some sort of negotiated settlement, because the US doesn't appear to have been materially as negatively affected economically, does that mean that there's going to be a growing gulf between UK interest rates and where they settle and US interest rates, or indeed European interest rates and US interest rates versus where previous expectations were? Does that make a material change to valuations as far as the major currencies are concerned? And talking about the currencies, well, we have updated our forecast, not massively, but we have updated them somewhat. You can see here that there's still this downtrend for both sterling dollar and euro dollar, although it's far more manifest in sterling dollar than it would be in euro dollar, again, because the UK is expected to suffer more significantly economically to the downside from the aftermath of this conflict in the Gulf. But equally, I would suggest that other currencies do have some potential risk as well. So things like the dollar against the yen had tested up towards 160. I think there's a little bit of downside risk in the short term, possibly more so as we get through the remainder of this year and into next. And by the way, it doesn't show this on this, but these forecasts are 1 month, 3 months, 6 months, 12 months and 18 months. So that's the order of the forecasts. If we look at things also that where currencies have been performing well, I would still question why is it that the Chinese renminbi is continuing to strengthen, because a weaker global economic environment set against a backdrop of weaker domestic demand in China is surely not a set of circumstances that ought to be driving a stronger Chinese renminbi. Quite the opposite, in fact, and yet the markets are still seemingly happy to strengthen the Chinese renminbi, albeit only marginally. But I do think there's some potential upside risks in dollar China. And then one other thing just to throw into the mix in terms of currency markets, I talked about the Swiss franc and other safe havens, but what about those currencies who are perhaps going to benefit from increased trade demands on their energy sector? And the one that I would highlight here is the Canadian dollar. Now, the Canadian dollar has been suffering recently because of the maneuvers that we've seen from Canadian separatists, and so that political weakness has fed through onto the currency. But I would expect to see the Canadian dollar strengthen because their trade flows, particularly in things like oil and LNG, should be stronger with the likes of the US. And one final point, what about the potential for this materially altering negotiations on the USMCA review come the summertime? So those are some of the the sort of areas that I'd focus on with regard to currency markets going forward. The dollar is strong at the moment. I think it may persist in that strength rather than weaken back, because even when the situation calms down, I think there's a greater risk of bigger rate cuts from the likes of the UK, at least one unexpected rate cut from the euro area, whereas the US will go back to predicting relatively few rate cuts from the US economy, from the Federal Reserve, even with a change of leadership in train, and the potential for that to come into being towards the end of May. So some questions just for your businesses to ask as what industries or geographies are at risk from the Middle Eastern conflict, and how are you positioned? What about shipping and freight costs, and also the cost of insurance? If there are some issues around the Suez Canal, will we see shipping have to be rediverted around the bottom of Africa? And the increased costs of that, will it increase insurance costs in terms of transit through the Suez Canal, if it is indeed passable at all? So that could also increase costs for businesses. How robust are supply chains? Movement of product and goods, and are ships out of place versus where they need to be? Are we moving back to a just-in-case rather than a just-in-time model for businesses? And what will that mean in terms of stressing things like working capital and a business's balance sheet, and how prepared are businesses for that? What about FX flows? Will the increase in cost mean that you have to buy more? Will the increase in cost mean that demand for those products drops back, and therefore you have to buy proportionately less per quarter? But ultimately, it could change things like overall flows. So you might normally have a particularly busy period in one quarter. Instead, you get a quiet period, but that quarter is then skewed to later on in the year or even into 2027 as the business catches up. So how will it materially affect your currency flows? Then finally, what about the risks to consumer spending and investment? I've already talked about some of that. And what about AI? Does AI still require the levels of investment, and do companies have the money to deploy? So a lot there to unpack. Now, in terms of questions, we do have some already pre-submitted questions, so do forgive me. I'm going to read from my pre-prepared piece of paper. So the first question is, given the Middle East tensions are driving energy prices higher while global growth is slowing, how should we weigh the risk of stagflationary FX moves against traditional safe haven appeal of the US dollar? Is the energy disruption currently a bigger driver for currency volatility than interest rate differentials? Well, if you don't mind, I'm going to answer the second part of that question first, because it's quite easy. Yes, absolutely. The Middle East conflict and the problems there are definitely the main issue as far as currency markets are concerned at the moment. Interest rate differentials are all over the place. But one of the things I would say is that the multifaceted change that we've seen in interest rate expectations across the globe have created quite a significant change in forward point pricing. So whereas previously, if you were going out sort of 6 or 12 months for sterling against the US dollar, and it would be marginally positive, it's now significantly negative. And the longer you go out, the more negative those forward points appear to get. So that's one thing that I would stress there. But it is almost certainly the case that interest rate differentials, apart from that forward point element, are not really driving behaviors in currency markets for the time being. When we do come back to this situation, we could easily see that if the UK is pricing in interest rate cuts again, that could have a negative effect on the spot price, whereas it will have a positive effect on the forward price. But I would predict the negative spot effect will be larger than the improvement that we see in forward pricing. And then on your first question about stagflation and FX moves and traditional safe haven appeal, look, ultimately, stagflation, I think, is a risk for all regions. It's actually probably a greater risk for Europe and the UK than it is for the US or indeed Asia, just in terms of where energy is drawn from. But clearly, if your economy is already growing slowly, then the situation in the Middle East is going to have a more damaging effect on growth because you weren't really generating much in the first place. Worthwhile mentioning that the US did print very, very weak fourth quarter GDP growth when those numbers were released. But I would still expect to see the downturn effect on economic activity in the US be less than the negative effect that we're likely to see in the UK and Europe in particular. So I still think the dollar has some safe haven appeal on the basis of the fact that the situation in Europe and the UK is likely to be worse macroeconomically. Now, we did receive a question about booking a forward contract for sterling to be sold based on the current euro sterling rate. Now, I can't offer advice with regard to that, but I think it is worthwhile revisiting what your requirements are, what your budget rates are, and speaking to your contact within Moneycorp. If it's something that you're looking to do, they can perhaps give you a greater insight into how the market has moved, what it means as far as forward points are concerned. But one thing I would stress is if you look at the scale of daily moves in things like euro sterling or indeed in sterling dollar, they have increased in size between the high and the low since the war got underway. So since the war got underway on the 28th of February, the average daily move in something like sterling dollar has been around 120 pips, whereas prior to that, it was under 100. So there is more volatility in markets, and whilst forward points have become more troublesome, or certainly are more troublesome than they were previously, because the UK was expected to see a closing in the interest rate gap between itself and the euro area, you have to set that against the backdrop of bigger moves in the spot market. So in terms of the third question, with all of the uncertainties going on around the world at the moment, is it likely to make the US dollar stronger against the pound and the euro? Well, this is it's not as straightforward an answer as you might expect, because it's yes, but clearly we don't know how things will evolve with regard to all of those geopolitical risks, and we also don't know how things will evolve in all of the macro economies. I mean, take out the war in the Gulf at the moment and take out the war between Russia and Ukraine, and look at things purely from a macroeconomic perspective. And one of the key trends has actually been how much slower and worse performing the US economy has been relative to the likes of the euro area and the UK. So the slowdown in performance from the US, certainly over the second half of 2025 and into the early stages of 2026, has been more pronounced relative to what we've seen in the UK and in the euro area. Now, neither of those economies are performing well, but we're just talking about relative performance. So if you were looking at this from a macroeconomic fundamental perspective, then without the conflicts, without the geopolitical risks, I'd say that the dollar might be under pressure. But with them and with the potential lasting effects that they are going to have regionally in Europe, I think that the dollar will continue to perform well against both of those currencies. And then we have another question here, which is, what's my short-term outlook for euro dollar? Well, we've seen it today, for example, testing up towards 116, and then previously we've seen it trading down towards 114. I think that that's the range for euro dollar for the time being, but I do fear that we will have more tests to the downside than sustainable breaks higher. And the reason I say that is I do think the European Central Bank is tying itself in knots over the problems that we're seeing with the Middle East conflict, and the short-term effects on inflation, which are clearly to the upside, versus the longer-term effects to economic activity, which are clearly to the downside. So my short-term outlook is more sort of range trading in that 114 to 116 region, but I think we're going to see more tests down towards 114 and potentially an eventual break through 114. So I've also been asked to explain the basis for my forecast for sterling dollar that was previously shown. So you see it heading lower down towards sort of 128 by the 12-month forecast horizon, and then 125 thereafter. I think there are several strands to this. One is, we've talked already about the effects of the Middle East conflict and the problems that will create for the UK much more materially than it will for the US. So economically, there's some downward risks there. I think there's some political risks as well. We saw over the course of the first quarter, the chief of staff that was a key reason for Keir Starmer taking the leadership in the first place of the Labour Party and then winning the general election back in 2024. He's had to step down because of the ongoing issues around the Peter Mandelson appointment for US ambassador and his relationship with Jeffrey Epstein. So that's one net negative as far as the political stability side of things are concerned. The other thing is that we've seen renewed speculation around the leadership about who might take over. So Andy Burnham was potentially going to stand for the Gorton and Denton by-election, didn't. Labour ended up coming third in that, so that's a pretty poor result for the government. And then you've seen other potential candidates on manoeuvres, so the likes of Angela Rayner also suggesting that that she's going to get all of her affairs in order for a potential challenge, should one be forthcoming. Now, that all revolves around the upcoming May local and regional elections. And at the moment, if you look at the polling data, the government is going to do very poorly. And so I think there's some political and macroeconomic risks there. I also don't believe for a second that the Bank of England would be seriously considering raising rates by 2 or even 3 times of 25 basis points each time. And that's what the markets have been factoring in. So I don't believe the numbers make any sense from an interest rate perspective. I think there's political risk out there. There's certainly geopolitical risk out there. And that's why I believe the forecasts are correct, and that we know we're at the bottom end of the range as far as forecasts are concerned. So we don't have any further questions, and it just leaves me to thank you very much for your time and attention today. I am aware it's April Fool's Day. So no, this wasn't an April Fool. This was a real thing. We hope you've enjoyed the webinar. If you've got literally 60 seconds to fill in the feedback, which is just showing here, that lovely QR code, please scan the QR code. Please fill in the feedback. We were told 2 minutes was too much, so we've reduced it to 60 seconds in terms of providing your feedback. We hope that you have a very successful second quarter that we're now in. We look forward to speaking to you at the beginning of May. So that's it from me. Have a great rest of your day, and goodbye for now.